All right, great. From our last class, we close out with government issuers. So today's class will build on that, and we'll be looking at the prices and yield bond valuation. Right. This exactly is we're now in the real reason why we are here, to value and price this asset. Right. And we talked about the convexity last week. So if you have a graph of the yield and prices for bonds, what you have is this convex line, right, that gives us that inverse relationship between price and yield. And like I always say, for fixed income, one thing we need to one tool we need very much in this is that tool we learn in our quant, which is the time value of money. Right. And once our time value of money is strong. All right. So in the price bond relationship, right, it said we're talking about what we need for this. One of the basic tools we need here is our time value of money knowledge, because we are basically trying to move money through time, series of cash flows, to determine what's the fair price or the value of the bond right at this point at time zero. So if I have series of cash flows all lead up this way, I then discount these cash flows to determine what the current price of the bond should be. Okay. Right. So at the first instance, case we'll be looking at is valuation of the annual coupon bond. And like we said when we were describing the features of bond last week, annual coupon bond pays a single coupon annually. So it's the present value of all of the bonds promised cash flow. Right. Now to describe the features, we said there is something yield to maturity, which is the market discount rate appropriate for discounting the bond cash flow. So what the issuer can determine, an issuer of a bond can present this, can say the amount of money they want to raise, which will be the par value of the bond. The issuer of the bond can determine the frequency of the payout distributions, annual or semi-annual. The issuer of the bond can determine its own coupon rate. He wants to raise money at 6%, right? But the issuer of the bond can determine the tenor for 4 years. But it is the market that determines this YTM. So somebody, based on the issuer specific attribute at the market rate, the market can say, we want to give you the same money, even though you are promising us 6%, we will discount your cash flows at 10%. So, and this will then determine the price, the present value of this bond, or how much cash this person can raise. Right? The market determines this, and we're going to see how we get to given this, we can then say the bond is being issued at par, at discount, or at a premium. Right. So let's consider this very important case. Consider a newly issued 5-year bond with 10% coupon, and frequency of distribution is annual. So what we have here is a tenor of 5, right? Coupon rate 10%, and frequency annual. Now, let's assume the par value is 10%. Sorry, the par value is 100. So we are going to do the YTM, what the market rate is saying. If the market rate is at 8%, we value the bond at that point. If the market rate is 10%, and if the market rate is 12%, and this really is, we are trying to do a scenario test that if the yield at which the people want to give them that money is 8% or 10% or 12%. Now remember our the timeline. So if the coupon rate is 10% and the par value is 100, that means the coupon in dollar term is $10, right? So let's draw a timeline. We want to value the bond at time 0. It's annual coupon bond, the final payout. I have these cash flows of 10, 1, 2, 3, 4, and 5. 10, 10, 10. I'll get 10 here also, but also get the par value back as an investor. These are the cash flows I'm facing as an investor, right? Okay. So the next thing I want to do then, and our calculator will get to this answer faster, but it's good for us to have the knowledge of what we are trying to do or what the calculator is doing on the back end. What we are trying to do is all these cash flows, we are discounting them at the yield. So this is the first year cash flow plus 10, 1 plus y again, year 2 cash flow, year 3 cash flow, year 4 cash flow, and remember year 5 is your Your 5 is your coupon, and as well as the par value being returned to you. It is this Y that the market determines, and that's the YTM. It's based on this Y that will discount all the cash flow the issuer has promised us to determine how much we are going to give to the issuer that promised us today. How much we are going to give to the issuer today. So let's plug in 8 here, 8%, 8%, 8%, 8%. So we have 10 over 1.08 plus 10 over 1.08 raised to the power 2. So somebody should help us do the computation, right? Plus 10 over 1.08 raised to the power 3 plus 10 over 1.08 raised to the power 4 plus 10 over 1.08. This is 110, right? It's power 5. Quickly, help us. What's the final value given all of these numbers? This is the long form, right? We can always get to this faster with our calculator, but at least it's good to do this once. So you know what exactly the calculator is doing.
Uh, 107.98.
107.18. Right.
98.
98. All right. Thank you. And that is the fair price of this bond today. Right. If we change this, and let's use our calculator fast. So we've done that. The only thing we need to do for this scenario is to change that 8 to 10 and change to 12 also, and we can use our calculator. So when we did 8%, we got 107.98. No need to do it long form again. We want to do for 10%, we want to do for 12%. So let's use our calculator to do for 10%. Go again on our calculator. I hope everybody can use the calculator now.
Can you please help us recap?
Can you do what?
Or the use of calculator? The
Okay,
coupon.
so on the calculator, you will see a portion that has N, I over Y, PV, PMT, and FV. Right, like the third row.
Okay. Yeah.
Okay, so in this case,
N is 5.
N is 5. Right, press 5, press N. Let's do for this 8%
1
again.
over Y.
1 over
Y is the 10%.
YTM. Is the YTM. Just in percentage time, 8%, just press 8 for 8%. Just press 8. Capture it as 1 over Y. PV is what we want to calculate. So skip that. PMT is your coupon rate.
Is it the coupon rate of actual payment?
It's the actual payment. So you don't put as rate, you put as the actual dollar payment. In this case, it happens to be 10.
Oh.
Yeah. This 10 is not 10%. It is $10.
Right. What is the future value? The FV.
Okay, just hold on. That's the PMT. The FV is your par value. And that will be 100.
100.
The next thing, just press CPT, compute. That's one on top of second function. Compute. Press compute and we press PV. What's the answer you got?
I'm guessing minus 149.48. Very narrow.
So you got minus 149.48. First, the minus means there's a cash outflow. So it's fine. That means you are paying 149.98 to get access to the bond, right? That's what the minus means. Why you are getting 149 is what we need to then trace now.
The interest rate 0.08.
No, I told you put it in percentage like that. 8. Put it as 8. You don't need to convert to decimal.
Oh, I converted.
Okay, please don't convert. Do that. Put it as and compute. We compute the PV.
Minus 7.98.
Fine. That's how to do this. Compute again for 10. All you need to do is to change that YTM to 10. Every other parameter remains the same. What's the price you get?
Okay. Minus 100.
The minus means is a cash payout. You can always just say 100, right?
Okay.
100. Let's do for 12%.
12%.
12.
92.79 minus 92.79.
Yes, 92.79. So really, that is basically pricing a bond for us. Right? We have the rates, and we put all of this, and we get the answer. We've done it in long form. We have used a calculator also. And you can quickly see, and we are going to get to that point where you say par premium and discount. Remember, when we value the same bond using 8%, we got 107.98. The value at 100, at 10, got 100. Valued at 12%, we got 90 something, 92.79. See, this is the present value. The par value, which is the future value they're going to pay to us, is the same: 100, 100, and 100. Anytime our present value is over and above the future value, like in this case, we say the bond is being issued at premium. It's a premium bond, and that only happens when the market yield is lower than the coupon that the bond is trying to pay to us. The coupon on the bond is 10%. The market is valuing at 8%, so we end up with a premium bond. When the PV is equal to the par value, we have a par bond. That means the bond is being issued at par. Right? PV is the same as the future value. When the PV is lesser than the face value or the par value of the bond, we say we're having a discount bond. This is very important. And we know that we get all of this when, if the market yield, the YTM, is lower than the coupon, we end up with a premium bond. When the YTM is the same as the coupon rate, we are going to have a par value, a par bond. And when the market is discounting at a higher rate than the coupon, we end up with a discount bond. Okay, let's move on. So the next thing I want to value now is valuing a semi-coupon bond. A semi-coupon bond. What has changed in this semi-coupon bond is the frequency. And it's very good for us to always note that frequency before we start using our calculator. So and let's imagine a 3-year bond, 3 years. The coupon rate 10%. The par value FV same 100. The frequency right now is semi-annual. Right. The present value is what we are trying to compute. Put this on a timeline. For semi-coupon bond, that means distribution of coupon happens every 6 months. For a 3-year tenured bond, we are going to have 6 periods, 6 distributions. This is at the 6th month. This is year 1, year 2, and year 3. There will be cash flow on the 6th month, cash flow 2, cash flow 3, cash flow 4, cash flow 5, and the final cash flow 1, 2, 3, 4, 5, and 6. Right. Now, on our calculator, the hen on this calculator truly means number of periods. Right. The period in this sense means how many time cash flow occurred on this asset. So for a semi-annual coupon bond like this, N in this case will be 9. Also, the coupon rate, we calculated that coupon rate is 10%, gives us.
Hello, why is N9?
Is that what?
You say N in this case will be 9.
Will be 6.
Okay, I wanted to say is.
Yes, 6.
Which you said 9. Okay.
Represent the number of times there is cash flow on this bond?
Okay, 6 times.
Yes, 6 times. Coupon rate is 10%, $10. What happens in a semi-annual coupon bond is they promise you $10 annually. They will split into 2 and pay you half on the 6th month, half on the second 6th month. So the actual coupon in dollar term will be $5. That happens every 6 months. So when you want to put the PMT, you will put 5 in this case. That means you divide the annual coupon by 2. The face value stays the same. Let's take our YTM. YTM in this case has 8%. Remember, our rate is quote per annum. The quote of this rate is per annum. For semi-annual, we are going to adjust it for the period, which means dividing by 2 also. So the 1/y you put in your calculator will be 4%. Any question? Okay. Let's compute our PV using this method now.
$105.24.
Yes, 105.24. Okay. Right. That's basically how we value our semi-annual. We can stretch this and say we want to calculate the bond with the frequency with quarterly distribution. So let's try that. 3-year bond. So let's put, this is really just the tenor. The tenor of the bond is 3 years. The frequency of distribution of coupon is quarterly. The present value is what we want to calculate. The coupon rate is, let's say, 5%. The YTM in the market is, let's say, 6%, right? And par value FV is same 100. So let's compute what the present value will be. So tell me, what N will I put in the calculator? What will be my N?
12.
What?
12.
Yes, 12. Thank you. Times 4. What will be my coupon? PMT.
15.
15. Somebody promised me 5% per annum. I want to collect the money every quarter. What the person will not change his 5 naira he wants to give me. But I want to spread that over 4 times. How will I achieve that?
The 5% of the par value divided by 4.
So what would that come to?
$1.25.
1.25, correct. What would be the I over Y?
Will be 6 divided by 4.
Okay.
1.5.
Yes, 1.5%. FV will be what?
You say what?
The par value will be what?
100.
Yes, that doesn't change. 100. So let's do this quickly. What will be the present value for this kind of bond?
97.27.
97.27. Right. So we have a graph of how to value these bonds now. We always have to take care of this frequency, not to miss it. Okay. The next one to do is how to calculate YTM. So we're assuming that we have every other thing. Let's say our tenure of the bond is 2 years. The coupon rate is, let's say, 5%. The frequency is annual. I'm going to do semi-annual too, just so that we see how these things differ. The par value of the bond is 100. The present value of the bond is, let's take 90. We want to calculate the YTM. So calculate YTM if this were to be an annual bond. Calculate the YTM if this were to be a semi-annual bond. Right. So if it were to be an annual bond, basically all of this comes to our calculator. So who can help us? It's just a case of you pressing compute I over Y, right? So enter all of this value correctly, just do our I over Y. If we do an annual bond, this will be our N directly. N is the 2. Coupon will be $5 in this case, right? FV is the same, PV is the same, compute I over Y. What's the answer?
The value is 90.
Yes, 90. Remember, it's an outflow. So on your calculator, please put negative.
Minus.
Yes.
As well. 10.82.
10.86%. Great.
82.
82. So now let's do the same computation, assuming that it's a semi-annual coupon bond. What will our N be in this case?
Before.
4. What will be our coupon be? PMT.
The rate will be 2.5.
2.5. Great. FV stays the same, PV stays the same. Let's compute. What's YTM?
$5.34.
5.34%. So what happens when we have any frequency different from annual? The calculator is giving us on a semi-annual basis. Please, we have to quote that rate, this YTM, on an annual basis. In this case, we will multiply again by 2 to get to annual. So whatever value you get, take it back to annual. So multiply this by 2. This comes to what?
10.68.
10.68%. That's our answer. In the exam, you will see this 5.34. If
now what you just pick?
What?
I think somebody's now what you just pick 5.3.
Exactly. Please, this is YTM on a semi-annual basis. All rates should be annualized, right? We'll take this back to annual basis to get 10.68, which is the right answer. Okay, so we have good graphs of calculating bond price and also calculating the yield on a bond if you have other parameters. All right. The next thing we want to do is accrued interest, flat price, and full price. This is also very important. So let's do accrued interest first. What do we mean by accrued interest? Let's take our 2-year bond. 2-year bond, year 1 and year 2. That is paying 10% coupon. So we expect 10 naira here and 10 naira, and as well as the par value on this day. This person has bought the bond here. If during the life of the bond, after collecting the year 1 coupon, maybe 2 months after collecting year 1 coupon, this man decides to sell the bond. The thinking or the question in front of us now is, what is the interest? Because this man has held this bond for, to be fair, right? He has held this bond for 2 months before the day of selling. What is the accrued interest due to him for holding these 2 days? Even though it won't be paid till this day, he has earned part of this 10 naira coupon coming at the end of the year for holding for 2 months. We need to attribute this 10 naira for the number of days that this man has held the bond before trying to sell. And that's accrued interest as at that day must be valued into how much he will be willing to sell the bond. That is our task. Our task for accrued interest is, I want to calculate how much is due or accruals that must have on this bond for holding for 2 months before deciding to sell in the month of March, because he had held it for January, held it for February. So how do we calculate accrued interest? It's a very simple formula. We do the coupon payment due, right, multiplied by the days, number of days since the last settlement, divided by the number of days and the coupon period. So take our example for as a case, we have $10 is what is due. This man has held it for 60 days, 2 months. The number of days in the entire coupon period is let's say 365 days, right? And using this, we can quickly get to how much is due to this man. Can we compute that? So he's held it for 60, fraction of 365 days, 365, 0.16 multiplied by your $10. So we need to pay this man to compensate him 1.64. Exactly. And that is the thinking behind accrued interest. I don't know if do you have any bond trader in the class? Somebody in fixed income desk, a dealer, trader. Do you have anybody in the class that's on fixed income desk? So we have concept of accrued interest 1. Now, the next concept we want to talk about is the flat price, which you usually call the claim price. And we have the full price, which
is that full price.
What?
Is claim price the same as full price?
No, it's not. For flat prices, another name for flat price is the claim price. Full price,
okay,
is the dirty price, the slang of the street. Dirty price.
That's claim minus accrued interest.
Aha. So basically, the full price incorporates the accrued interest on the, and how you do this is we can calculate our full price directly, right? We take the so for our full price, we take the bond value. We value the bond as at the last coupon payment date. Last coupon date, then mark it up, right, by the accrued interest till the settlement date, the date that we are trying to price the bond. So we do something like the bond price at that last coupon date. Then we'll do 1 plus YTM adjust this YTM for frequency, right? Then raise to power the number of days that this person has held the bond over total number of days. We're going to have a live example of this. So once we calculate the full price, we calculate, so for flat price, I will get the flat price is the full price minus the accrued interest. It's not the other way around, right? But we can compute full price directly. We can compute AI directly. We then infer the flat price from these two parameters. Is this clear? Theoretically, is this clear? Before we move on. All right, great. So let's then practical. So we are clear with AI. It's quite straightforward. So let's do an example of a full price. So let's take our bond. The tenor of this bond is 2 years. The coupon rate 10%. The YTM is 12. FV par values 100. Now, the task on our hand is that this bond is about to change hand on day 70 days after the first year. This is year 1. 70 days after the first year is when the bond is about to set to change hand to another person. Like we said, we are going to value this bond in year 1. So somebody can help us calculate what's the PV of this bond, the price of the bond at the end of year 1, just after paying the coupon of year 1. What is the price?
What? Annual coupon?
Yes,
is it an annual coupon?
Yes, annual frequency. Sorry, let me put frequency. Annual. So after paying the first year 1 coupon, what is the price of this bond? In this case, just help me. N will be what?
N will be 2.
No, at the end of year 1. We are pricing at the end of year 1.
Oh, at the end of year 1. N will be 1, sorry.
Yes, N will be 1. Payments will be what?
10.
Yes, N will be 1. Then I over Y is
12.
Yes. FV is 100. PV is what you are calculating. So let's do that.
$98.21.
96, right?
I got 98.21.
Okay, 98.21. Great. Remember, this is the formula we are trying to achieve. We are going to want to calculate the full price of this bond. We have done the first part of the formula. Bond price as at last coupon payment date. The next thing is this adjustment for accruals that we want to do on the bond. Okay, so how do we achieve this? We have 98.21, so let's go. 98.21 multiplied by, we said 1 plus YTM. The YTM on the bond is 12%. 12%. Adjust for frequency. The frequency here is 1, right? Raised to power number of days since the last settlement. 70 days has gone.
70 days.
70 days. Total number of days in the coupon period. Let's take 365. Right. And that's our formula now. This one to solve for. So we'll get 98.21 multiplied by 1.12, right, raised to power 70 was 65. This 65. 0.191, 192, 0.192. So let's solve for this. What do we get? One point one two base power 0.192. What?
That should be 2.4564.
Okay, multiplied by 90. The final answer is what?
I got 2.4564. 2.45.
Okay, 2.45 are the final answer.
Yes.
I don't think so. So let's 1.02 multiplied by 98.21. 100.37. That's the dirty price.
Oh, sorry.
This is the full price of the bond. So now we know the full price. The next thing we want to do is, were you able to get this?
I have 103, 100.36.
100.36.
Yes.
Okay, very close. Now let's go through the next action. Calculate the accrued interest. Right. Coupon payment is 10, right? The coupon payment is $10. So we have.
What did you calculate here?
I want to calculate that. No, this one is the full price. The full price of the bond.
The 98.21 we got. What is this? Is the claim price?
No, this is the bond price as at last coupon payment date.
Oh, as at year one. Okay, this is it as at year one, and that's 70 days.
Yes, this one is the full price as at year one and the 70 days. We have adjusted the 70 days with this formula, with this part of the formula. So next, I want to calculate the accrued interest, which is the coupon multiplied by the fraction of the days elapsed, 70 over 365. This should give us like $19 or something, right? 19.17. Now the final task is, what is the
Sorry,
flat?
the coupon is 10 now. The coupon is 10.
Yes, $10. What is the flat price?
I'm getting 1.91, not 19. 1.917. Yeah.
Okay, I think it is correct though. Multiplied by 10, 1.91. Thank you. It's 1.91, not 19. $1.917. So the final thing to calculate is the flat price, which is the full price minus accrued interest. Our full price is 100.36. Accrued interest is 1.917. So the flat price is 98. Yeah. Basically, so that's how we answered this question. Please don't go for flat directly. Do the accrued interest, do the full, and from there infer the flat price. It's very important for us to do that. So we don't just do last bond price. Bond price at last time, this 98 and just slam on this accrued interest, it will be wrong. If you just do 98.21 plus 1.91 and you think that's the answer, right? It give us a very wrong answer. So we have to go to the full first, then take out, then do our accrued interest, then subtract it out. Are we clear on this?
Yes.
Okay, great. Also, just to note, day count basis for bonds could be actual, right? And sometimes could be 30/360, especially if you have foreign currency bonds, our euro bonds and the rest. But then our NGN will use actual and the rest. So we've gone through all of this. Very important, let's look at the relationship between bond price, coupon rate, maturity, and yield to maturity. Right, and when we go back to this, our convex bond again. Right. Anytime, if, okay, so let me just board right. And I've alluded to this earlier also. That if I have this is our YTM, this is the price, and we have a convex nature of the bond. Anytime this, let's say this 8%, this is 6, and this is, let's say, 12. If this is the yields in the market, if the coupon that the bond is promising to pay equals this yield, the bond will be trading at par. Whatever par is, 1,000, 100. But if you move and the market rate declines, you know that the coupon rate is fixed for the tenure of the bond, unless you're having a floating rate note. If it's a fixed rate note, right, and the market yield moves downward to 6, what happens is that the bond price rise up. In this case, we might settle at something like 112, right? Also, if the market rate goes up to 12, the coupon rate is still fixed. The price will decline to something like 80. Right. And that is essentially what we're talking about when we say the price and yield are inverse. The yield goes up, the price came down. The yield goes down, the price went up. Very important. Another thing we want to talk about is the relationship between prices and maturity. And probably we've done this also on our on our FSA. Now let's take example for that our bond that we issued at discount at 80. The other bond issued at premium 112. The other guy was at par. As we get closer to the maturity, this is the maturity date. What you observe is, as you get closer to the maturity date, the bond will start trading very close to this par, right? And the concept is called constant yield trajectory, right? Okay. So you have constant yield price trajectory, right? Which says, as we move, even though this thing was issued at discount, as we move towards the maturity of the bond price appreciates towards the par value. Call it the pull to par. Even when the bond is issued at a premium this way, the price also will decline towards this day, towards this 100 mark. Essentially, that's the pull to par. So the relationship between pricing and maturity. On this side, we talk about the relationship between price and yield. Also, price yield and also the coupon rate. So that when the bond is issued at the same coupon rate as the market rate, we have that par or discount or premium. Okay. The last part of this, before we'll take some break and come back and do the textbook questions. Matrix pricing. So when we talk about matrix pricing, what are we trying to achieve? For matrix pricing, we are trying to infer something like the price of a bond that is not trading based on observable market prices. Right. I have a bond for a particular company, maybe Abiola company. I issued a bond, but that bond is a private note. I'm carrying it on my books, on my financial statement, right? And somebody wants to buy off the company. Remember, if you want to do the enterprise value, they will say, give me the market value of the liabilities. Part of the liabilities I'm carrying as a private company is my bond. Now, the question for that auditor or the financial analyst that is trying to value the company is to say, how can I derive the market value of the bond on this person's book?
Hello, you call, if you have bond on your books, you call it a liability. Are you the issuer?
Yes, I'm the issuer. Yes, I'm the issuer. So I'm the issuer, I'm the company that have issued the bond, it's on my liability, right? So somebody is coming as a financial analyst, they want to value my company, right? Part of the task the person needs to do to come to enterprise value or this rest is what is the market value of the bond on this company's books, right? And because the bond is not trading, it's a private note, it's not listed anywhere, you can't observe the market price directly. So the easiest way to achieve that is to go find a comparable bond that has for a company that is trading, that you could observe the price, you could observe the yield in the market in real time, and infer from there, apply that yield on my own company bond to then determine the price or the value as at the time you are valuing the company. And that's what we call the matrix pricing. So what we want to do for matrix pricing is find a comparable. And what are the comparables you want to do? Comparable in terms of tenor, comparable in terms of credit rating. So that I can compare up likes for likes, right? So if my company is a rated company, please, the comparable you have to go and look for in the market should be an A-rated company also. If my company is a 5-year bond or 5-year time to maturity, please. Also, the comparable you pick is a bond that has 5-year life to it. Right. And basically that's what we'll be doing. So let's take an example. If I want to value this company bond, that's 5 years to maturity. Let's say it's an A-rated company. The comparables that I can see in the market that are A-rated companies. So all I need in that place is their yield, right? I have company A. Company A is I picked it. It's let's assume that I don't see a direct 5 years. I see a 4-year bond, A-rated also, right? All of these companies are A-rated. The yield in the market is 6%. I saw company C, right? This one is actually 6 years time to maturity with a yield of 8%. So I've seen two companies A-rated, but I don't see a direct 5 years. And that's why matrix pricing comes in. Matrix pricing is trying to say, how can I prorate given these two timelines? I have one for 4 years, I have one for 6 years. Can I infer extrapolate from these two, what a 5-year yield should be? basically. And how do we do that? These are basics. We do the 4 year, so that will be 6% plus the difference between these two guys. So I have a difference of 2 years. So what I want to calculate is what the 5 year mark will be. I'll do 1 divided by the difference between these two, multiplied by this 8%. This difference between these two years, 8 minus 6. So let me write it.
Don't get it.
What?
Can you come by 6%? I did not get your idea. 6%, which is the coupon for the A-rated plus.
Is the yield for the A rated that is 4 years? That is 4 years.
Okay, the yield for the A-rated is okay. The yield for the C-rated is 6%.
Yes.
Then the bracket say 1/2 of what?
Okay, let me take another approach to explaining this. This is the, let's say we are going, this is 4 years, 5 years, 6 years. For 4 years, I know that it is 6%. For 6 years, I know it is 8%. Given these two data points, can I infer what the rate will be for a 5 years? Now, for a 5 years, I can say, now that 5 years, the basis, I'll take my bearing from the 4 years yield, plus, I know that there's plus, what's the distance between these 5 and 4? 1. The distance between the next data point I have and 4 is 2. The difference in the yield between these 2 points is 2%, right? So I can then do 6% plus 1%. That should give me, given this data point, I can say that the yield for the 5 years should be 7%. That means yield goes up by 1% every other year. One year is 1% increase in yield. That's why we were able to get to 8% on the 6th year. Does this make sense?
Exactly.
Okay, so let us do a much complicated scenario. If I have 3 years, then the next data point I have is 8 years. I want to compute the rate for year 5. I know this one is 2% in the market, and this one is, let's say, 7%. Let's compute, but extrapolating this using these two data points, what should be the yield for the 5 year? Like we said, look at the difference in this place, look at the total difference, and then look at the difference in this yield. Take this 2% as your base, 2%. Then you are going to add on the difference between 3 and 5 is 2. The difference between 3 and 8 is 5. The difference between this yield is 5%. Right. So to be 2% plus, this is 1, 2 times 1, 2%, into 4. So this guy should be 4%. And a lot of assumptions this is clear, right?
Yes.
Exactly. A lot of assumptions is in this computation. We are assuming that the yield curve is linear, right? But sometimes we have very, very funny yield curve. Something, so we are assuming this very straight line for the yield curve. But hey, trust me, sometimes you could have something like this that kinks. You have all of this kinking yield curve, right? But as an abstraction, like the just to simplify things, we assume this very straight yield curve to come to this kind of matrix pricing. We can also use the matrix pricing. You know, the focus here is yield, right? We're using yield to extrapolate out this number. Another way we could do this is to focus on spread. I could use yield directly in this in this instance because I'm comparing corporate bond with the corporate bond. If I don't have a corporate bond that has the same yield spread as this guy, or that has the same rating as this guy, and I want to take my bearing from a federal government security. So, what would I do in that case? If I have a, let's say, an FGN 2 years, I have another FGN 5-year bond. This 2-year guy is at 2%. The 5-year guy is at 4%. If I have a corporate of 2 years, a corporate of 2 years, it is at, let's say, 3.5%. So the first thing I first do is to calculate the spread. The spread over a comparable 2 years is 3.5 minus 2. So what the investors are asking for taking credit risk in this corporate issuer is 1.5% spread. 1.5% spread. Based off on this, if they say I should compute what is the yield for this corporate 4-year bond, I want to calculate what the corporate 4-year bond will be. I can do this also by saying I'll start my bearing from 2 years, federal government 2 years, 2% plus distance between 2 years and 4 years, that's 2. Distance between the 2 years and 5 years for that government is 3. Multiplied by the difference in this yield is 2%.
Okay.
Right? What will I get? 2/3 of 2%. 2 divided by 3 multiplied by 2. Right, 1.33 plus 2%. 3.3. So this, right? 3. Yes. This 3.3 I'm getting here is a federal government 4 years. That means the federal government 4 years should be 3.33%. They're asking me for a corporate 4 years. What I would then do is do the federal government 4 years, 3.3, then add the yield spread I've gotten earlier, plus 1.55.
Is this yield spread given, or do we need to compute it?
If this what?
Is the yield spread, is it given or it has to be computed?
We computed it from the start also. That's when we did the corporate 2 years and the federal government 2 years. It is from this, the spread over the federal government 2 years is what gave us this 1.5 as the yield spread. That one stays constant, right? I will then go calculate the federal government 4 years, 3.3, and add on top of that the yield spread the investors are asking for. This will then bring us to 4.83 as the right yield for a corporate 4 years. All-in rate, 4.83. Are we fine on this also?
Yes.
Okay, great. I think that is the note for this class. We are going to then go look at our textbooks. I'll give us a 10-minute break. Let's reconvene by 3:45.
Yes.
Okay, so this is where we need all our calculators. This is where we need that response from the class, just for us to know that we all understand what we have just talked about. The foundation for so many things we'll do going ahead. All right. So this question is asking the price of the bond. Matures 2035, pays semi-annual coupons. Coupon rate is 3.25. Face value of 100. Market discount rate is 4. Trade settlement of 1st of January price of the bond, assuming 3360-day count. Okay, so let's try. What is N in this case?
N is 10.
Exactly. What is I over Y?
So that's why I got it.
This is the I.
Oh, it's supposed to be 2.
Yeah.
I use 4.
Okay. What will be our PMT?
2.25.
The semi-annual. Let's adjust for frequency. The semi-annual coupon. So adjust the 3.25 for semi.
5 times 2. 6.5.
No, it will be divided by 2. The same way you divide the rates by 2, you divide the 3.25 by 2 also.
$1.625.
Okay, great. What's par value?
100.
Okay, so let's compute PV. Compute PV, what's the answer?
$93.39.
Yeah, 90 what? 93?
I'm getting 93. I won't see this. Let me see this.
Let us do it again. 10 N I over Y 2 PMT
625.
1.625 FV 100 compute PV. What are you getting now? I can't hear you, Sam.
I am at the office too, that's why I'm not paying full attention.
98.23.
Okay. Bolaji, what are you getting from the side? Okay, I can hear you, Emmanuel.
I'm getting 98.23 now. I can't even see it.
96.63. Right?
Yes.
Okay.
Yeah.
Okay, so Bolaji, are you computing from your side also?
Yeah, but you can go ahead. I'm following.
Okay, so that's correct answer. Emmanuel, thank you. Okay, let's move on. This kind of questions, the time allotted of the exam is 3 minutes max. So I need that speed. Question 2, please.
It's not.
Yes, the guy must not default. you have to hold the bond to maturity. That's why it's even called yield till maturity. The coupon must be reinvested at the same rate as that yield till maturity. I must not suffer any default, else I will not get that rate of return. Okay, question 3. Can you see actual? That's the basic we are using. Flat price, that's what we calculate. So let's walk through this together. But I want the full attention of the class. Right. This is a 3-year sovereign issued on January 1st, 2030. Coupon are paid on 30th June and 31st of December. So let's put this on our timeline first.
Manual.
Semi-annual. This is semi-annual coupon. Let's draw a timeline. What kind of question is very good for us as a timeline, so we don't get confused. For 3-year semi-annual, we are going to have 3, 6, 1, 2, 3, 4, 5. So let's put 1 year. We're going to have 6 payments. It said June, December, so we'll put J, D, J, D, J, D. Okay, so we want to value settlement date on 29th of August. 1. So this is 2030. January 2030. This is June 2030. This is December 2030. This is June 2031, 31, 32, 32. Just the 3rd year. Settlement on 29th August 2031. This is where we are. August 2031. Right. We want to find the flat price on this day, 29th. So a couple of things to do. The first thing we have to do is to value the bond as at this day. June 30, 2031. That's period what? 1, 2, 3. Period 3. When we have 3 more periods to go. So in that case, our N will be 3 to go. Right? Our FV is, let's say, 100. Let's look at our columns. Semi-annual coupon of 1.5 per year. That means the coupon is 0.75. The market discount is 2%. For semi-annual, we are going to use 2 divided by 2, 1%. What is the PV on this day? Using all these parameters. Calculator, please.
What's the coupon? What's the coupon?
0.75.
0.75.
Yes.
$99.26.
Thank you. 99.26. That is the value of the bond as at the last coupon payment date. Let us now find out what is the time elapsed between June 30 and 29th of August. Remember, we are doing actual. So, number of days between 29 August minus 30 June. What would that give us?
60 days.
60 days, right?
Yes.
Yeah, thank you. 60 days. Between June 30 to December 31st, how many days?
June 30 to December 31st.
Yes, in 2031. Remember, it is actual 2031.
184 days.
184 days. Okay, great. Period 184 days. Okay, so now based on this, let's calculate the accrued interest, which is the coupon multiplied by the date since settlement over days in period. The coupon is 0.75 for that 6 months multiplied by 90 days over 184. So this gives us what? 90,
0.244.
0.294. Great. So we have our
44.
two what?
0.244. 244.
Okay, thank you. 0.244. Now the next thing we want to calculate is what is our full price. We say we are going to do full price, which is the last bond price, multiplied by 1 plus YTM adjusted for frequency raised to power days over total days, right? So let's do that. Our last coupon price is 99.26 multiplied by 1 plus YTM is 2%. So we'll do 2% over 2, right? Frequency raised to power 90 over 184. So you have 99.26 multiplied
So
by.
where did you get the 90 from?
Yeah, you told me 90 here. Yeah. The number, okay, 60.
So 60.
Oh, great. Sorry. This is 60. 60. Sorry. 1.01 raised to power 60 over 184. .326. What do we get?
That's 1.032 multiplied by 99 times 26. 99.58.
Great. The full price is 99.58. Our flat price, flat is equal to full minus AI. 99.58 minus AI accrued interest is what again? 0.244. 0.244. What do we get?
99.33.
9.3, right? So basically that's what we want to. Yes. Can we see? That's how we get to this our answer. Yeah. It's very simple. We walk forward, we walk backward, just that we know what exactly we are trying to do, and we put the formulas quite straightforward. Okay, let's move on. This is true or false question. Is this true or false? We said earlier that the price we quoted is usually the flat price, right?
Mm-hmm.
This at the point of settlement, because if you don't
We had accrued interest at the point of settlement.
exactly,
So the bond quoted price is not
exactly. So this is false.
not the full price.
Okay, good. Question 5.
B is the answer.
10-year, we have a smaller percentage change than the 30-year. Why?
Because of duration, the longer the tenor, 30 years.
Yeah. Okay, let's true or false. Metric price is an estimation process on which quotes from derivative market, interest rate swap are used to determine the price of illiquid new bond for which transaction data are scarce. True or false? Yes. What?
True.
No, it should be false. No, we say that what we take our bearing from is not from this derivative market, it is from comparable bonds.
So
So that is exactly where the cowboy is. Not a derivative market. We take from the prices of comparable bonds.
bond.
Okay. So that's it for this. We look through maybe your spare time. Please look through the examples again and also solve the end of chapter questions. Yield and yield spread for fixed rate bonds. For fixed rate bond. Okay. So we open the class by looking at our economics. Let's in economics, we have the nominal rate, the rate that's being quoted in the market, right? It's a combination of two things. The real interest rate plus the expected inflation, right? Okay. So, and we can even distill this even further and say our nominal rate, let's say for example a corporate issuer, a corporate will be the real rate that I would charge on a risk-free instrument. So we can call this real rate, or we call it the risk-free rate. For corporate issue, I will add risk premium because of the higher risk I'm facing with this man. Risk premium. And on top of that, I will add the expected inflation adjustment. So that if I know this risk premium is same like that our credit spread, right? So if I know that the federal government is doing 2%, for Dangote I will add another, let's say 2%. Inflation is whatever it is, 30 or something. So we can get the nominal rate, something close to 34. Anyway, so we have this, a breakdown of the interest rate, the real risk-free rate, the expected inflation, and the risk premium. We tell about the yield to maturity. A single discount rate that set the present value to its market price. And so if I know the PV, I know the FD, I know the coupon, I know the tenor. I can compute the yield to maturity. Okay. So this is just us trying to analyze a yield. So effective yield calculation. So if I have a particular bond, right, I calculate the yield to maturity based on the coupon payment with my calculator. Another thing I could do is the true yield. And this true yield will involve looking at those repayment dates one after the other and adjusting the actual number of days based on those ones that will be paid a day earlier or 2 days after, because the coupon payment date falls on a bank holiday. Because the coupon payment date falls on a bank holiday, and that's how we do a true yield. Right. So now let's couple of computations here. Current yield. For a current yield, focus on this. And when we talk about the source of return on bond, the last class, right? We said our bond return comes from the coupon, the capital gains when there is changes in yield, and FX if it's a foreign currency. When we say we are calculating the current yield, we are focusing exclusively on just the coupon that we earn on this bond. We are neglecting all of these other sources of return. So that's why we say focus on the simple source of return, which is the bond annual interest income. That is cash over bond price. So if the coupon is $60 per year and the price I pay for that bond is 90, this is quite a lot. $6 per year and the price of the bond is 90, I can quickly calculate that the current yield is 6 divided by 90. That will be 6.67%. That is the current yield. Okay, a simple yield. Another computation is simple yield, which accounts for premium or discount. So if you have bought the bond at a premium or at a discount, so that is annual coupon payment plus discount over bond price. So in this case, I've bought this bond at a $10 discount. So I'll do 6 plus 10 over the bond price 90. So that will be 16 over 90 in this case. That's for simple yield. If I had bought it at premium, so I bought the bond at 107 and the coupon is 6, or let's say the coupon is 12. So that my simple yield in this case will be 12 minus 7 because I bought at a premium over 107. So that will quickly depress it to 5 over 107. It's less than 4% or something. So if it to be a discount bond, we add the discount to it. If it's a premium bond, we subtract the premium from the coupon. Okay. I think we discussed this in the class last time. The callable bond. We have the yield to call, yield to worse. Let's talk about it. So I have a 2-year bond. Annual 6% coupon, 7% YTM, right? But it is callable in, let's say, the year 1. Let's take this for 3-year bond. Year 1 is callable at 102. Year 2 is callable at 101. If not, it stays to maturity at year 3 and matures as 100. So if they ask me that yield, what's the yield to the first call? this case, what I'll be calculating is, and I'm buying the bond at this point. N first callable at year 1 will be 1. PMT will be 6%, which is $6. YTM is what I've been asked to calculate, yield to first call. PV is the price of the bond today. So if we do this, we'll get the price of the bond today. And FV in this case will be the price that they will go to call the bond in the year 1, not the 100. We're going to use the 102. 102. So 2 things for the class. Let's first calculate the PV.
So the
Okay.
FV 100 signifies maturity of the bond, Abi.
This one at year 300, yes.
No, you said that 100 stands for maturity of the instrument. But here now, the future value is 102.
Yes. Why? Because we are calculating yield to the first call.
Okay, not the maturity.
Not to the maturity. And you know that on the first call, if the bond is called, they will pay us 102. That's why the FV in this case is 102. Because that's that will collect at that first call date. So let's first calculate the PV given these parameters: 6% coupon, 7% yield to maturity. What's the present value? N is 3, annual coupon bond.
N is 3. What is the yield?
7%.
99.00.
99.00. That's not what I got to. You know, we are first doing it for the full 3 years. So what do you use as FV in this case? Or that your computation?
102.
102 what? No.
102.
No, it won't be 102. We are doing for the first 3 years, for the entire 3
Okay,
years.
for the first 3 years, not the core.
Not the core yet. We are not doing this one yet. We are want to do this one first. So your FV should be 100. So calculate again.
$102.67.
Let's do this together. N is 3. I over Y is 7. Just type as we are calling it. PV is what we want to calculate. PMT is 6. FV is 100. Compute PV. What's the answer?
97.37.
Exactly. Why are we getting something else before?
I don't know what I said.
Please, we have to be careful. If not, let us always clear TVM, because this kind of wrong answers will be right there in the options. And these are cheap questions for us. We can't be missing them. So every time you want to calculate TVM, please clear TVM so that you don't carry the previous numbers. So we have the present value as 97.37. Now come here, we want to calculate the YTM. Now we know the PV. That's PV is the amount we bought the price. The bond is 97.37. So given this, let's compute YTM. Again, now use all of these parameters. Now, what do we come to?
My N is 1.
Yes.
My future value here is 102.
Yes.
The PV is 97 minus 97.37.
97.37, yes.
I'm calculating my I1.
Yeah.
My PMT is 6%. Please, Abi.
Yes, 6.
10.91.
Great. 10.91%.
Yeah.
Yield to first call, 10.91%. Calculate again. Yield to second call. Now,
Yield to second call
if it's being called at this point at 101.
at 10.
Yes. In this case, N will be what?
N will be 2.
Yes. N will be 2. FV will change to 101. Every other thing remains the same.
$7.95.
Yes. 7.95. 7.95%. That's the yield to second call. Now, it's very important. So, this is yield to second call. The yield to maturity is 7%. We've calculated it here already, right? So, I have three yields on this bond. Yield to maturity, 7%. Yield to first call, 10.91. Yield to second call, 7.95. Now, there's a very question they can ask us, which is yield to worst. Yeah, what they are basically asking us is that out of these three yields that we have for this guy, 1, 2, which one is the lowest yield? The lowest yield is the one that when the issuer does not call it and the bond stays to maturity.
Maturity.
Yes, so the yield to worst is 7%. So if I'm faced with this kind of bond, what I will be praying as an investor is that, please, God, let this issuer record this bond in year 1, because that's when I have the highest yield on this bond. That is clear, right?
Yes.
Okay, great. Let's move on. So we understand what yield to call means. We understand what yield to worst means. We'll talk about this also the other time. Yield callable bond, straight bond, the value of call option, right? Value of the price of the straight bond, or the value of the straight bond minus the call option value. So let us do this. First time, the question they'll be asking us is on this: what is the value of call option? It's basically the straight bond callable bond. That's of the straight bond. That's of the callable bond. Okay. We move on to option adjusted price. So we talk about option adjusted price is yield. So we have option adjusted yield. yield on the bond if we're not to be callable. What will be the yield on this bond if we're not to be callable? Like in price as a straight bond without the call option. No, we say that option value is option free bond, that's the straight bond, minus the callable bond. So option adjusted in this sense is saying that price this callable bond as if there are no option embedded in it. As if there were no option embedded in it. So that's option adjusted. So there you can see the option adjusted bond is like the no option embedded. Prices as if no option embedded in the call. Basically, we are saying price this bond as if it were to be a straight bond. I say that option adjusted yield most times are lower than the callable bond yield because in that sense the price will be higher for a straight bond. Okay, so what are the yield spread? Now I'm going to what we are here for. Yield and yield spread measures for fixed rate bonds. What's basically the yield spread? Yield spread is the yield on this particular bond we are doing, the bond yield minus the yield on the benchmark security. Your benchmark can be a number of things. If your benchmark is a government bond, this yield spread we can as well call it the G spread. That's the spread of a bond over a comparable government bond. And thank God we did the matrix pricing just now. We can use the matrix price to determine the appropriate maturity benchmark yield. So if I want to find the G spread for a Dangote 5-year bond, and I don't have a federal government 5-year bond, but I have 2-year bond, I have 7-year bond, I can quickly, by interpolation and matrix pricing, calculate what will be the expected yield on the federal government 5-year bond. And once I have that, I can then go compare that with the Dangote bond and calculate what is the G spread. G spread, fancy name, all it means is that the bond on the Dangote corporate issuer minus the yield on the federal government bond, the difference is that yield spread. Another one we could be asked to calculate is the interpolated spread or the I spread. The yield spread over comparable swap rate. So swap rate will be I will probably we'll do swaps when we do our derivatives. When we do our derivatives, swaps are forward commitment too, right? Basically, swaps are used by banks in their transactions to say if I'm going to swap a particular let's say a fixed income instrument, what is the rate that transaction will happen. So what would the I spread represent? It represents the extra return of a bond excess of the interbank market reference rate used in swap contract. I price my swap contract based on this market reference rate. So if I have a market reference rate for a 5-year swap at 4% and a corporate issuer's bond is at 6%, the I spread will be the 6% of the corporate issuer minus the swap rate, which is 4%. Things to note, it must be the same currency and the same tenor, so that we are comparing likes for likes. So if I'm calculating the I spread for Dangote of a Naira bond of Dangote, please, you have to get the swap rate for a Naira transaction too. Right. So again, what are swap rates? These are the rates used for interest rate swaps between banks. Why are we doing yield spreads? So yield spread is essential for analyzing the factors that affect the bond yield. So let us take a cue from here. So let's take we are using yield spread. An MTN bond, 5-year bond, the yield currently, if the yield currently is at 7%, and say a federal government 5-year bond, the yield is 3%. My G spread in this case will be 7 minus 3, that's 4%. I'll say 400 basis points. Now, the question is, that's the last number I remembered. G spread for MTN is 400 basis points. If I then resume on Monday and somebody told me that yield spread for MTN is now let's say 500 basis points, the yield spread has widened. What is causing this? I need to understand. Two things can cause this. No, I know that yield spread is the yield on MTN itself minus the yield on the federal government note. Two things can make this thing widen. Either if the yield on MTN goes up, or the yield on federal government securities goes down. Either of the two can happen. It's even worse if the two happen at the same time. If the yield on MTN bond is going up and if the federal government bond stays the same, I can start having increase in yield. I can have increased G spread for MTN. The same thing if the yield on MTN stays the same, but federal government securities yield is falling. This can still lead to widening in the G spread. So that's why we say I'm doing the G spread for me to understand the source of the changes in the yield I'm seeing in the market, so I know where the actual thing is, or where is the change, where exactly is the change happening. So it could be macro or micro. So macro will be what is affecting the entire market. If the risk-free rate is increasing, if the expectation on the inflation is increasing, right? If it is micro, it will be what is peculiar to MTN, either the liquidity risk in terms of how quickly you can convert that MTN bond to cash, or the credit risk, or the perception of default on MTN, or if there's an increase in taxation too, it can really affect the yield spread too, because people feel like anytime they earn money from Dangote bond, they will be taxed at higher rates. They need to adjust and compensate for themselves for that higher taxation, and that can also widen the yield spread. Any questions so far? Any questions so far? Let's move on. Spot rates. And I think we talked about it last times also, in terms of we do this by doing bootstrapping. Bootstrapping will be me computing the yield on zero coupon bond over a maturity. So I start with my T-bills, 30, 60, 2-year zero coupon bonds. So for the spot rate, the bonds I used to compute on this spot rate, we have to be zero coupon instruments. So TBs is a zero discount. So they are going to be pure discount instruments, right? All of this. So they have a zero coupon, and it is based on that I will compute this spot rate. Okay. So you can also compute what is the spread over this spot rate. So captures our rate value over term structure of interest rate. So if I do this spot rate using zero coupon bond for that if government instruments, and I do same for corporate, I can get this spread over it. This is my spot rate. Given the same maturities and all of that, I do a rate for a corporate issuer. The difference in this yield is what we call the spread over the spot rate. You have to be, I plot all of that also over same maturity and compare the same 1 year discounted instrument with the 1 year discounted corporate also to find the difference. Okay, I could do zero volatility spread. This is very important because zero volatility spread is a yield spread calculated over the benchmark spot rate, producing the equal value of the market of the price of the bond. So what I will do for you. So let's do a 2-year corporate bond. I'll first ask what is the spot rate, 1 year spot rate. 1 year spot rate is 3%. Now, this one is looking at on the wrong government securities. What is 2 year spot rate? 2 year spot rate is, let's say, 3.5%. And this corporate promises 6% coupon. And currently it is trading at 97 naira. Thereabout. So what I will do is 97 equals to 6 over 1 plus this 1 year spot rate is 3% plus Z. That Z is a plug-in, this for 1 plus this will pay 106 in year 2 over 1 plus the spot rate on this time is 3.5% plus Z. Now it's over 2. I'll then go use, I want to find the value of Z that if I plug into these two spots must give me the bond price in the market today. We already do this with our Excel, all those go sick. And that's Z spread. Z spread is saying that what is the plug-in value that I will plug to the current spot rates that will equate the pricing, that will equate the discounted value of the cash flow on a particular corporate bond to the current market observable market price. That's what we are doing on that page. Option adjusted spread, we talked about earlier also. Spread on the government spot rate curve that the bond will have each rate to be option free. Say our option adjusted means we are valuing the bond as if there were no option. Prices as if bond had no embedded option. Okay. So what is option value? Option value, like we said earlier, could be straight bond minus the callable bond. Another way to find the option value is to do what is my Z spread. Z spread minus the option adjusted spread. This will give me the same option value. So let's take break till 5.
Yes.
Okay, so what I want to do for the next an hour is to consolidate our knowledge and try our hands on questions. Okay. So so what will be the answer here? Just trying to test. all rates are analyzed, right? All capital market securities and money market rates with maturity dates later than 1 year are analyzed, right? So that's what we talk about rate are quotes on a per annum basis. However, money market rates are not what? Should not be compounded. So let's solve question 2. YTM. This is our calculator again. 3-year sovereign priced at 106, PV of 106, FV of 100, 2% semi-annual coupon. What's the YTM? These are our fast questions. We'll be able to do this as fast as 1 minute, less than 1 minute.
.039.
0.039. That's the mistake we talk about. That rate you just got is semi-annual. You have to analyze it. Times 2. So what do you get times 2?
You multiply by 2. 0.07.
Exactly. That is negative 0.77, right?
Okay, because it's the minor. What do I get?
No. Yes, it is negative 0.77. Is that what you get?
No negative on my.
Okay, that means you have made mistake in your inputting. When you put in 106.24, did you put negative in front of it?
Yes, I think I did.
You did that.
Let me clear mine. I did.
If you have done that, you will get negative yield. You use negative because the bond is at premium. Do it again. What are we getting?
My PMT is 4 now.
Eh?
My PMT is 4. I don't know.
It can't be 4. It is 2% for a year. Half year will be half of that. If you have to pay somebody 2 naira for a whole year, you can't pay him half year 4 naira now.
Minus 0.036989.
That is the half year YTM. You must quote, and if you are based on that, you have picked B, you will be wrong. You have to quote the annual. They ask for annual yield to maturity. You must
0.0739.
0.0 exactly. That's the answer. So you have to be cautious. Sometimes they will put, so if you have picked B, that's 3 marks gone down. Right? And the marks for level 1 now, they are much more, you don't want to miss any question, not even the one that you have struggled to calculate. Just that you are now stopping here. If you stop here, it's still a wrong answer. And to be sad, if somebody should stop here and because of that, somebody is missing that answer. You have to just multiply by 2 to get the right answer. You have to be cautious of this, please. What is the G spread for each of these bond? The benchmark government bond is 1.1.
For A,
What is it?
0.17.
0 point exactly. Right, for each of the bonds. So what will
For
be the
B,
spread for bond B? So just all subtracting
0.113.
exactly. Just all subtracting all of this. But also, you have to adjust for, please. We have to adjust for this semi-annual. The comparable bond is on a semi-annual basis. So all of these guys that are annual, these guys is quarterly. We have to adjust it to be semi-annual. And how do you do that? That's what we have in our notes right here. How to convert annual yield. Like I said the other time, level 1 is a case of how much you know and how much formulas you can recognize, and how fast you can type that calculator. 1 plus ytm over n raised to power n minus 1. That's the formula. So for this case, I'll do 1 plus 1.1271 over 2. I want to convert to 2 over 2 raised to power 2, right? So basically do 1 plus over 2. So that's how I get 1.267 from 1.271, right? 1.267. Is this clear?
Yes.
Okay, let us quickly see how we can use our computer, our calculator to quickly get this answer. If you look at your calculator in keeper 2, on top of it you see something like I convert, right? I convert.
Where is it? Okay.
Can you see I convert?
Which row? Which row on the P?
On your keyboard, on your kidney, you see that where you press 2, figure 2. The second
Okay. I
option
see
for,
I convert.
yes, is I convert. I want to take us through how we can quickly get to these answers without these formulas using our calculator. So if you press I convert, you will see nominal NOM. You will see, if you press down arrow, you will see EFF. If you press down arrow, you will see C over Y. So let me put it on the notes so we can just follow as a team. We have EFF means effective yield. NOM means the nominal yield. C over Y means frequency. Frequency, right? Our task is to convert. So look at this case now. We have 1.271 annual yield. We want to convert it to semi-annual. That means the effective yield on this case is 1.271. 1.271. The nominal yield is what we want to find. What should be the quote if the frequency, now the frequency for semi-annual is 2. Frequency for quarterly is 4, right? So that's what we press. On our calculator, when it shows nominal, when it press the arrow down to EFF, or the EFF page, press 1.271 and press enter. Have we done that?
Yes.
Press down arrow again. C over Y, press 2. Press enter. Have we done that?
Yes.
Press down arrow again. It has come back to nominal, right? Press compute. What is the answer you are getting?
1.265.
1.266 exactly, and that is how they got to this answer, 1.267%. So this will help us very fast in the exam hall. Now, based on what you just done now, can you do for bond C? Convert this bond C, find the equivalent yield to maturity if it were to be semi-annual. Now it is quarterly. Let's go.
Are we to clear first? Are we to clear first?
You don't need to clear in this case.
No.
What's our answer?
1.1728.
Exactly. Can you see 1.17? And that is the very fast way to get our answer very fast in the exam. So I don't need to memorize this long formula. Just it's good to know the formula, right? Also know how to get to this place with your calculator. Okay. Question 4. What's the answer?
I'll choose A.
A. Let's go back to our books. We said value of call option equals to the straight bond price minus callable bond price. Now, they told us that the value of this call option is positive for this bond. Also, based on this, we can say that a straight bond equals to callable bond, right, plus value of call option. Do we agree?
Yeah.
Exactly. Now, if this value is positive, and you're adding that value as positive to this callable bond, will the straight bond be lower or higher?
Yeah.
But see this, the value of the call option is price of option free minus price of the callable bond, right? If the value of the call option is positive, then the option adjusted price is lower compared to the flat price of the bond. I don't what is option adjusted price is lower. Because if the value of call option is positive, the option adjusted price compared to the flat price of the bond. So what are they referring to as the flat price of the bond? the flat price of the bond should be the price of the callable bond as it were, right?
We cannot accrue interest.
What? Hello?
So the flat price is equal to the price of the bond.
Aha. And if that will be our callable bond, right? And if we take straight bond as value of the call option plus callable bond, I think the straight bond should be higher. This says it should be lower. Anyway. So basically that's it. Look at the examples again, and like we said the other time, let's solve some of the end of chapter questions. Look at this question now. Aha, this is a very good place to test that our calculator now. Look at it. Yield to maturity of -0.5 when it were to be annual, right? If the yield is converted to monthly. So if I'm talking about monthly compounding, my C over Y will be what?
12.
Yes, let's do that on a calculator now. What will be the nominal yield if I'm doing this 0.5, but I'm doing monthly compounding? What did you get the calculator?
0.501.
Aha. Is that less than or greater than -0.5?
.501 is less than.
Aha. So it is less than. So that's how to get to this answer. So we don't want to just pick the answer from, we calculate it. We are damn sure of what we have taken, and those are the right. That's the way to actually pass this exam. You can get to the point where any answer you pick, you are so sure that you are getting it. Okay. Let's move on. When you calculate the yield YTM of a strip, zero coupon bond, the periodicity must be 1. True or false?
Calculating yield to maturity is false.
Do I need questions? Do I need to have? I don't need to have that periodicity of, because I can always compute it from, even if it is more than 1. Okay. Let's see some questions. So it's good to solve all of these questions, all of these examples in our own spare time. We'll talk about the yield to call and the rest. You can see you can have yield to first, second, third, fourth call. It doesn't stop. Once I have the number for all of this, I can always. Let's try and match this. Simple yield. What does it characterize? What does simple yield represent? We talk about it when we open the class.
Page 4.
Simple yield is 4. No. Remember our calculator for simple yield. We said coupon plus or minus discount or premium over flat price over the present value. Remember, that's when we did this. I can't find it now. So we say that simple yield does coupon plus or minus. If it is, we plus it if it is a discount bond. We minus it with a premium over price. That's simple yield. Can you remember this formula? Your simple yield will be number 3. Okay. Effective annual rates.
1.
1, Abi?
Yeah.
Yeah, yield measure assuming 1 compounding per year. Effective annual rate. What's street convention? No, we have street convention yield, we have true yield.
Number 4.
Yes, number 4. So we are left with number 5. D meaning number 2. Government equivalent yield assumes convert to actual from 360 days. Okay. Great. Let's move on faster. Our time is fast spent. Fixed rate, matrix pricing, we've done that. So what's G spread? I won't stress out to do the Z spread because of our calculators and all that. But what's G spread in this case? For IIF bond. So how do we do this? We have a corporate that is 1.5 semi-annual. We'll calculate the yield on that. Then we'll do this government also. Calculate the current yield. But remember, this coupon is 0.75 here. So after computing the yield, we'll then calculate the yield if it were to be a 1.5 coupon paying government bond also. You do up to those two yields that will form our G spread. G spread is the spread over a comparable government bond. Let's see. G spread is, and the government bond is this. 0.03 gets 0.89%. That's 89 bips. Okay, when we talk about this earlier, Z is what we add to the spot rate cross board. We have all the spot rates here. These are the spot rates. So what's constant value are we going to add across board to all the cross rates to get the current price of the bond? So that's why we use this solver in Excel to do this in real life. Okay. Let's see what else we have. Practice problems. How many questions we have? Not too much. 5. Can we try again? Based on our effective yield, let's try it again. quarterly coupon, has 3 years to maturity, currently trading at 97.28. So we can calculate the yield already. So what will be the yield on this instrument? Then we'll take the yield based on semi-annual basis. We'll take it to based on quarterly basis. No, we are currently on quarterly basis. We'll take that same yield to semi-annual basis. Help us. Who's trying this? Trying this. So first, tell me what's the yield? What's the current yield on this instrument? Based on quarterly basis. So let's put this on our calculator. Coupon of 3.25 spread over 4 years, spread over 4 times. 3.25 divided by 4. That will form your payment, right? Face value is 100. N is going to be 12. 3 years times 4. Present value is 97.28. It's a cash outflow. Put negative in front of it. PV. Compute I over Y. 1.055. Adjust it to annual basis times 4. 4.22. Right? So you giving 4.22. Now find the nominal yield if it was to be on semi-annual basis. So on your calculator, use effective is 4.22. C over Y, take it to 2. Norm, compute norm. Right, 4. So second answer. Take your 4.22, C over Y, take it to 2. The norm was 176. .22 nominal. What do we get? Let's go. G spread, we talked about it in class already. The I spread over swap rates. Right. And again, what the swap rate? 3-year swap is 1.84. All of these questions are quite straightforward, right? Once you know what you are looking for, we're just computing numbers against number. G spread is the spread on the company bond. The bond maturity is 2.7 over a comparable government bond. A 2-year corporate bond, a 3-year government bond is 1.9. So what I essentially doing is 2.7 minus 1.9. So let's take our time to look at these questions, and we'll continue from here tomorrow.